We have Sam. He's been a leader at the intersection of technology, financial services, and insurance for over 20 years. He co-founded and led the U.S. arm of Founding Circle, which is the world's leading marketplace for business loans, eventually scaling it and taking it public. In 2014, Sam became the co-founder and CEO of Vouch Insurance, a digital insurance platform that provides tailored coverage to protect other founders from financial losses. He's already raised over 160 million to help startups reduce risk through insurance. Sam is very passionate about providing other founders with the protection they need for their business from start, and he has led the company becoming a leading digital insurance platform in the market. There's a lot to unpack and very little time, as always, so let's get to it. So Sam, before jumping into Vouch Insurance, you founded the U.S. arm of Founding Circle, as I mentioned, a marketplace for business loans. Can you go more into detail on what Founding Circle did and what were some hard-learned lessons from that journey? Since I'm sure is quite a long one, and I'm sure there's always lessons learned from there.
Sure thing. So in 2011, I co-founded a business that we ended up merging with Funding Circle in 2013. And long story short, what we were focused on doing was solving the availability issues with respect to credit and lending capacity for, call it Main Street small businesses all across the United States. This is in the days, and years shortly after the financial crisis. Banks were still really not lending actively to small and mid-sized companies. That led to, frankly, a lot of pain and frictions, even for very high quality businesses that needed expansion capital. And one of the things that I had done prior to Funding Circle, I'd run business development for a company called Second Market, which was an early innovator in terms of using an electronic marketplace-based approach to form capital for non-traditional assets. And so the insight that we had was, what if you took a similar kind of business model approach, a marketplace, and use that to bring non-bank capital in to solve the capital availability needs of small companies? And so beginning in 2011 and all the way through 2018, for about 7.5 years, I was focused on building that company up. At scale, Funding Circle was doing, hundreds of millions a month in loan originations across the United States, the UK, Germany, the Netherlands, and Spain. So quite international footprint. And the model was really, simple but challenging. Simple in the sense that it was a marketplace. On the front end, we'd bring in prospective borrowers, we'd do the credit assessment, and then we'd have a variety of different marketplace mechanisms to fill out those loans. And Funding Circle ended up going public in 2018. I used that as a moment to exit stage right, took some time off, and then started what's now Vouch.
Very cool. And throughout that journey, building out this marketplace, building out the company, what are certain things that you came across, whether it was recruiting, whether it was sales, whether it was operational? What are some things across your journey as you were growing, as you were scaling, that if you think and you say, if I were to go back, here are some things that, in hindsight, we could have either done something to improve something, or what's something that comes to mind?
Well, Alejandro, I'm going to give you a glib answer, which is all of those are hard, and I made mistakes in all of those areas. And I think that's one of the challenging things about company building is it's a decathlon, right? People liken it to a marathon. I actually think that's the wrong metaphor. It's a decathlon in the sense that it is multiple different events, and you got to be pretty good at all of them. So yes, I made mistakes with respect to hiring. I hired the wrong people from time to time. I made mistakes with respect to organization and culture and performance expectations. I made mistakes of not getting people off the bus if they weren't the right people to get the business to its next level of scale. Operations, right? And this honestly ties in with risk management. At moments, I was too external in my orientation. I was focused on partners and distribution and capital, and I let operational details slide. And there were moments where that really came back to bite us. And so, I tend to think about this, now having kind of been through the journey a couple of times. I think you have to have a pretty comprehensive framework around what is important in a company and rebalance your attention depending on where you are So you're making sure you're focused on the right thing at the moment in time. And again, I think that's more decathlon-like than marathon-like.
That makes a lot of sense. I usually leave this question a bit later on, but since we're talking about this journey and when a company's scaling in different phases along the way, what are there things that now you know the difference between, when you had 100 employees to 200 employees to 300 employees? You talked about things you've done, mistakes that you committed when you were recruiting or even within your operations. Are there things that, looking back as a company scales, that you say this is one thing that a founder really needs to keep track of, really needs to understand as a company scaling?
Yeah, definitely. So I would try to simplify this down into there are like 3 phases you go through. And then once you get through these phases, there are other phases, but they're more as a mature business. But in the context of being a startup, the first phase is you're really small. Maybe it's a few co-founders and a few team members. I would characterize this phase as like 0 to 20 to 30 employees. In that moment of time, it's really about finding product market fit, starting to develop hypotheses around what channels are going to work, pulling in the right financial and personnel resources to be effective, and making sure that you set the cultural foundations of the organization in a way that is sound. Generally, as a founder or as a CEO, you can have direct influence over almost everything that happens in a company during that phase. And so you don't have to worry a lot about management structure or operations or OKRs or any of that other stuff, because the reality is you're kind of in a room, whether it's a physical room or a virtual room these days, but you're kind of like all in it together. And managing the number of bilateral human interactions you need to influence the outcome is pretty straightforward. Not easy, but straightforward. The second phase is in that kind of 30 to, depending on who you are and how the company is going, maybe somewhere between 100 and 150 people, the famous Dunbar number, right? During that phase, you can still have a direct personal relationship with everyone in the company, but just as a matter of course, you can't be aware of everything that's going on. And so during that second phase, you have to start introducing basic management structure. You need people in the company whose primary job is actually managing other people, right? You're still going to probably manage a lot of folks directly yourself, but managerial process, goal setting, planning, thinking about efficiency in addition to growth, that's a really important set of disciplines in that second phase. The third phase, which is where Vouch is today, is in that kind of over 130, over 150 and scaling moment. This is where getting really tight on metrics, alignment, organizational communication, business process, the emphasis in the role as a CEO shifts pretty materially toward those things. And the reason for that is you simply cannot be in control and master all of the details on any given day of everything that's going on in the company. And so you have to have systems and tools and processes and people and organizational structures that do a lot of the heavy lifting within that business. It's in this phase where you start to have executives, not just managers and leaders, but like proper executives who are overseeing large groups of people. And I think the challenges and where you need to shift your attention are just, again, different relative to those 2 earlier moments.
Thanks for breaking that down. Let's move to Vouch Insurance. What can you give me a little background on what led you to jump into this space in particular? I know that Vouch Insurance targets specifically tech startups. And so I'm curious to know, how did it get started, and what problem led you to really focus on for startups?
Yeah. So first off, I'd done a lot of work in the insurance space earlier in my career, both on the strategy consulting side and then actually as an investor. We were very active in the insurance space. So I had some familiarity with it. I hadn't built a company in the category though. And one of the experiences I had at Funding Circle, and also, by the way, through a bunch of other businesses where I was involved as an investor, was frankly, insurance and risk management were just broken. They were very slow, antiquated processes. The actual coverage and expertise wasn't tailored to meet the needs of high growth entrepreneurial tech forward companies. Honestly, it wasn't until Funding Circle was a pretty mature business, well over 100 million in revenue, kind of getting ready to go public. It wasn't until that point in time where I felt like the insurance partners we were working with actually really understood the business and were able to offer us really thoughtful and kind of transparent approaches on risk management and risk transfer. And so seeing that, we just saw this incredible gap in the market where early stage as well as growth stage companies in more innovative verticals like tech, like health and life sciences, like frontier categories like climate tech, AR, VR, robotics, these businesses were just not well served by the incumbents. It was a bad experience. The coverage itself wasn't right. There wasn't necessarily vertical expertise from the intermediaries you worked with. And as a result, there were huge gaps in coverage and pricing. And so we started Vouch as a specialist to specifically help entrepreneurs manage their most important risks. We do that today through a digitally native set of insurance coverages. Those include the basics like general liability and business personal property, but we also cover more complex risks like directors and officers, errors and omissions, employment practices liability, cyber, and a number of others. And so today we now serve thousands of companies across the space.
What's your sweet spot? Which, in terms of ideal customer profile, what does that look like?
Again, any venture-backed or venture-backable company, tech, health and life sciences, high-growth consumer products, frontier, whether you're 2 people, 200 people, even up to 1,000 people, that's really the aperture that we focus on.
And I saw a number of the insurance that are mentioned: general liability and business property, directors, errors, omissions, fiduciary, media, employment, hired, cyber, crime, all these different ones. A lot of them are related to offices, like, and properties. I was very curious when I looked at the property one. There are many companies that are going hybrid, many companies that are remote. Has that dealt something?
So a couple things. One, just to be very direct about it, I disagree that most of the coverages are tied to physical office spaces. Certainly a business owner's policy or commercial package, those do tie to premises, i.e. offices and contents, physical stuff you have in your office. But things like directors and officers or employment practices liability or cyber, frankly, are very important and very relevant regardless of the physical footprint of how you build a company. We actually see, if anything, lots of additional strains being put on business in some of those areas because not all of the tooling and approaches to company building have shifted well to operating in a virtual first environment. And so when I think about like the risk vectors, i.e. what could go wrong in a company, whether you're building a virtual first or hybrid or more traditional kind of in-office culture, some of the risks you'd think about on D&O or cyber or employment practices liability, those risks are still very present and should be front of mind, particularly as you start building teams, launching products, and engaging with investors.
Which one of these, let's say for companies, startups that are from 2 to 10 employees, right? Super early, they still received, whether it's pre-seed or seed funding. What are some of the products that have worked best for you when you were approaching these companies that really sat, that connected with them, with those founders, with those teams?
Sure. So I'll start with a quick disclaimer. Vouch is obviously a regulated business. I cannot give blanket insurance advice. So I cannot advise people in general to do one thing versus another thing. What I can say, though, is what I would do. And what I would do, or what I would tell a friend, not in the capacity as an insurance advisor, but just as a friend, is early on, cover the basics, right? Don't worry about a lot of this until you have product in market and lots of clients and lots of data and more complexity. But early on, just think about what I think of as the basics, which are a business owner's policy. And the instant you raise outside money, or if you're in a regulated category, think very seriously about D&O. We see an awful lot of companies who early on have disputes over intellectual property or disputes with investors or regulatory issues where that issue may not be existential for the company, but it could cost you hundreds of thousands of dollars. And so when you're a small company, that could be a material part of your overall capital. And
what's an example? What's like common example of this when you're
Sure.
mentioning
I'll
directors
give
or
you
officers?
I'll give you a couple of very concrete examples that I personally have seen. So one example is where either a founder or an early team member worked at a company, not even in the same space, but in a similar space. What very
Mm,
oftentimes happens is you will get sued for intellectual property reasons and trade secret reasons shortly after starting or shortly after having these people join. It happens all the time. And
mm,
unfortunately, many companies use litigation as a weapon, really, to prevent innovation in their space or to try to prevent innovation in their space. And even if there's zero malfeasance, i.e., zero bad intent, zero breaking of contractual arrangement, doesn't matter. You still can get sued. You can still have to deal with these much larger companies who come after you. I saw that
got it.
personally in one of my prior businesses. We had a company come after us for reasons of trademark. We were scared. We thought we were going to have to change a lot of aspects of how we were talking about ourselves and our brand. Went through some legal hoops. Fortunately, we were able to resolve the issue. Now, what I see serving thousands of companies is that stuff is all too common. So, intellectual property, trade secret, trademark, those are common occurrences.
Got it.
A
That makes
second,
sense. Mhm.
a second thing we see very oftentimes early stage companies will serve other companies. Well, you don't necessarily have to do anything wrong to get sucked into someone else's mess. So we support now many companies who are vendors to companies who've gone through serious regulatory and or legal disputes. Oftentimes our clients get pulled into those as third parties and have directly legal defense costs or investigation costs that
Mm.
come in as part of that. And so even if you are small, if you're a vendor to someone else who is bigger and more exposed, you can have that direct issue. Um, Third issue that we've seen similarly, cyber incidents. Either you're using a tool that causes a first party loss or client loss, or you provide a tool where you have a cyber issue. For example, maybe there's just a AWS node where the security settings are misconfigured. Very common mistake that folks on engineering teams make. I've seen it firsthand. Well, what happens if you leak some of your client information, right? Almost always there's going to be an investigation that needs to happen. There'll be
Mhm.
client communications. There may actually be statutory notification obligations as well. And so it's really annoying and frustrating and painful to deal with this stuff. But again, these sorts of things happen all the time.
Sam, when you started Vouch, did you first generate traction at some point to then be able to fundraise? Or I know you ended up raising over 160 million so far. How was that early journey for you? Did you immediately? I mean, you've been in this space. You knew you wanted to target these tech startups. Was it from day one? Here we go. We signed up a number of companies already to get going, or how did that look like?
Yeah, well, so I'll start by admitting we had a reasonably easy go of capital raising in our early days, in part because I think we had a really experienced team around the problem early, and we had a very
Mm,
clear vision of what we wanted to achieve, and in part because we had two capital partners, one of whom is also a strategic partner, who were really excited about the idea and wanted to partner with us to build this business. And so
mm,
that conviction early on, particularly on the strategic side, I think was very helpful and clarifying and gave us a real leg up with respect to capital. Um, I'm a big believer in the lean startup approach, except for
mm.
when I'm not. And what I mean by that is there are certain businesses you can't really take a lean startup methodology to. If you're building a rocket ship, there's no way to really lean startup that. Like you need to put lots of money in and lots of
Right.
capital to work to build a rocket ship. And I'm not going to claim that insurance is rocket science. It's not, but it is more in that direction versus being a pure play lean software or consumer internet company or consumer products company where you can actually get the business going for a few $100,000, maybe $1 million. In insurance, you have statutory capital requirements, you have counterparty collateral needs, you have to have staying power, vis-a-vis the different partners you need to actually get up and launch. And so it's really hard to take kind of that like raise a little bit of money, prove it out, validate, iterate, and end up as an insurance business. You kind of have to have that conviction and capital from day zero, which I do think is again not general advice I give to anyone, just specific to building a company like this in this category.
Got it. So because it was in the insurance space, there was already a major hurdle of it's a lot more capital intensive for you to be able to get all the requirements under your belt to be able to then offer the services that you wanted to offer.
That's correct.
How did
Basically,
that look?
the bar for an MVP in insurance is higher than in certain other categories.
Got it. When you did, in that case, what did that look like for you? So your first raise, I mean, did you say, well, right from the get-go, we raised 10, 20, whatever million, and with that, it allowed us to get clearance on this, to doing this and this,
Yeah.
and this. Were that similar
Yeah, no, I mean,
numbers?
our first, we did a standing A to get the business going. So we raised about 25 million bucks right out of the gate from a strategic and a couple of financial sponsors. Ribbit and Silicon Valley Bank were our two anchor partners. Pretty quickly, we brought in Y Combinator and YC Continuity as an investor as well. And those were important stakeholders to our success, and they've been great partners as we've gotten the business going.
When you started, I'm always fascinated about the first couple of customers and clients that came in, right? That you onboarded, that you said, this is what we do. And all of a sudden they say, yep, that's exactly what we need. What did that look like for you? Was it exactly how you expected? Where you said, all right, the minute we open our gates, there was a line waiting outside, or what did that look like?
I'm not, nor have I think ever been a believer in build it and they will come. I think it's very hard to catch bottled lightning. I think in the early days, you always have to go out and evangelize for what you're doing and convince people to try out or switch. In our case, we did that with a lot of companies that we knew here in the Bay Area. We also actually made the decision pretty early on that our first market we were going to launch in was Utah. Insurance is regulated primarily by the states. And so you have to go state by state as you think about launching new insurance products. Utah obviously has a wealth of great startups. It also has a reasonably business-friendly and straightforward approach to insurance regulation. And so we knew that from a regulatory approval perspective and a market availability, it'd be an interesting place to get going. And in hindsight, we debated that decision a lot, but I'm really glad we did that because we were able to go and serve some amazing, primarily Salt Lake City based, but kind of Utah state companies early on, got the word of mouth going. And, it was definitely a lot of, push and push and push. And my co-founder, actually, he spent a lot of time physically in Utah doing this, but basically it's those kind of on the ground efforts that got us from 0 to about 100 clients. And once we got to about 100 clients, that's when we started turning on more proactive partner marketing, performance marketing, developing other channel partners, and also beginning to broaden our product and service offering.
Has the channel partnerships, has that been of huge help? Has that been very successful for you? And what did that look like?
Well, so again, my general belief is partnerships are where startups go to die. So I think generically good advice is don't have a partner-driven strategy on go-to-market early on. And that's exactly what we did at Vouch. And for us, it has worked. So our partners today account for a majority of our go-to-market volume. I will say a benefit has been a few of our anchor partners were early investors in the business, and we had very, top-down kind of senior level sponsorship of what we were doing in those organizations, which is what has enabled then us to work very collaboratively with them to get the business moving. And so, yes, partners are a really important piece of how we built the company. I think it's really hard to do. There's just a real misalignment, not necessarily of incentives, but more of timescales. When you have a young, fast-moving company try to partner with a, scaled and slower-moving business. But in our case, given we had, frankly, a long kind of waterfall-driven approach to build our initial product, that also actually, the silver lining of that was it gave us the opportunity to do some setup work on the channel side, such that when we were ready to launch, we'd already done some of that work and we'd already, used the time that we needed to use.
When you raise that A and that first 25 million, I'm guessing the team, and you're talking about how it's hard to be lean when you are in the insurance space. What were your first recruits? What did your team look like? I mean, at that stage with 25 million, I don't know. I'm trying to guess what size, what responsibilities were key for you. Where did you say, you know what, we could have more of that, but we're just keeping it lean,
Yep.
and I'd rather dedicate and invest more of our resources here?
Sure. So for us early on, there were call it 4 team member areas we thought about building out, and we definitely overinvested in some versus others. So the first was obviously product and technology. Um,
Mm.
Neither I nor my co-founder are software engineers. That's not our background. I've obviously overseen technology-driven businesses. I've worked as a product manager, but I'm not a software engineer, nor a CTO, nor is my co-founder. So we knew that getting a leader in to help us with digital product and technology early was going to be important. On the insurance and regulatory side, actually, our 2 first senior hires were our chief insurance officer and our general counsel, both of whom
Mm.
are still with the company and both of whom have done an amazing job helping us lay the right regulatory, underwriting, insurance innovation, and risk capital arrangements necessary to scale. Again, I think good general advice is don't hire too many senior industry people too early on in the startup's journey. I think, again, counterpoint would be if you're in a regulated space where in order to be credible and in order to frankly build things right, you need that expertise, you should just go get that expertise. And you should find the person who has deep expertise and credibility, who also wants to build and who's going to be nimble and iterative and do well in a startup environment. And we're just we're so lucky to have a few senior people from early on who have those backgrounds. So that would be
I love
the second
that.
area was kind of insurance and regulatory. Third area was go to market. That's actually where we chose to underweight team build. And instead, my co-founder and to some extent I spent a lot of time out in the market building distribution partnerships and talking directly with clients. And it wasn't until we'd gotten a little bit of those kind of early evangelist driven sales going, it wasn't until then that we actually went and hired our first sales lead. And there was everything else, right? I mean, we did have a couple of like key support roles. We actually hired our head of people pretty early on. Part of that was
Mm.
because we knew recruiting was going to be an important thing for us to do. We needed to pull talent in to insurance. Insurance isn't an obvious category, at least then wasn't an obvious category for talent to want to flock to, particularly talent that hasn't come from insurance. And so we wanted to solve the talent problem. Also, we wanted to make sure we had the foundations right with respect to organization and culture. And so that was another investment area.
I love that. I've heard many times from many founders that leave the HR director surprisingly until much later on, which always surprises me because I too feel like the culture, the recruiting, that's super vital and important for a company. And I mean, and then on the flip side, I've had other founders that, employee 10 and they have that HR, that person in
Yeah.
HR that's there.
Our HR leader, who's our VP of people today, still leads the function. I think he was employee number 8 or 9. To
Yeah,
give you a sense.
I love
So
that.
we definitely made the decision to bring him in pretty early, and I'm really glad that we did.
Did you have to test different pricing strategies, or from the get-go, the one that you had was the one that worked and right away as you were introducing this service to founders, startup founders?
Given we're insurance is risk-based pricing. So unlike in software or services where you're pricing primarily based on, a value-based assessment or cost-based assessment, in insurance, it's a risk-based assessment primarily. Competitive factors weighed into that, but at the end of the day, a majority of the premiums we collect get paid out in claims expense, right?
Mm.
And so you have to think about it as for a particular risk or for a category of risk on a portfolio basis, what is your expected loss rate? And then you actually have to do a build up to what your pricing needs to be in order to cover those losses, make sure you can pay for the operations infrastructure, and that includes some residual profit for you as a business. And if you don't get that pricing right, you will go away. And the easiest way to go away as a company in insurance or lending or to some extent payments due to fraud is get those dynamics wrong, right? If you get underwriting wrong, you go away and it'll look great until it doesn't, and then it's really bad. So we spent a lot of time thinking about how do you get your pricing right? And by right, I mean fair and accurate. And that is obviously a constant ongoing bit, as we learn more about how our book performs and as we get better at categorizing and analyzing risk.
Is the in terms of cost for the founder, right? When they're looking at the different types of insurance products, is that an area where you say that's a competitive advantage for us, or even for other insurance? Is that a big piece of a competitive advantage for an insurance company, or is it mostly based on the onboarding experience as well as the access to to certain technologies that make you better than others?
Sure. Well, so let me try to answer this in two parts. The way I think about this question is there really are two things you need to answer. One is, what do you need to do in order to offer a compelling solution for clients, i.e., what is your right to win? When I think about our right to win, I think about it as coverage that is tailored and appropriate for the companies we serve, pricing that is fair and in a lot of cases lower than what they'd otherwise get, but most important, it's fair, it's accurate, a digital experience that makes it very convenient and easy to interact with us, not only at time of application, but also over the full life cycle of an account. One thing people forget about insurance is it's not just the getting of it, but it's also how you evolve it. And also what happens if you need to use it? What happens if you need to file a claim? And so we think about that dimension of the experience as a really important one as well. And then the last thing that I think gives us right to win is we have a lot of folks on the team who are very good at offering client advice and client services to help entrepreneurs understand and manage the risks in their business. Some founders understand this stuff intuitively. They've been through it before. A lot of folks haven't. And that's fine. Like, again, you kind of have to be, our moniker for it is, as a founding CEO, you kind of have to be the chief everything officer. And we view our role as, frankly, helping share some of that load by leaning in and offering good advice in those areas. That's obviously linked to how I think about our competitive advantage, which is more around our equity story, right? And some of these things are important for Vouch to exist as a company, but frankly, our clients may not care about. And so when I think about our competitive advantages, that's where distribution comes in. That's where the technology platform, where we can build, configure, deploy, and manage commercial insurance products in a very efficient way. That's where that piece comes in. Our clients don't see that. We see it, though, in terms of our ability to evolve and support multiple different products on one common infrastructure. And then a third source of competitive advantage is obviously our ability to predict and understand risk appropriately. And this is where we see lots, I personally have seen lots of companies go sideways. They come in, their pricing doesn't make sense. They grow very quickly in an underwriting category, could be lending, could be insurance, could be payments acceptance, could be some verticals in commerce. And the reality is, if you get risk wrong, it'll look great until it doesn't. And once things go sideways, they often go sideways very quickly and very badly.
What are some common mistakes you've seen from other founders when it comes to go to market and it could be it could also be within your space, right? It's very common. I've experienced this many times within the marketing space, but for people to be fixated on exactly what the competition is doing, who the competitors are, who is this and that, and for instance, I see more founders, friends of mine, spending more time on competitors than what their customer, speaking with their customers and what their customers' experiences are like. Are there certain types of mistakes that you've come across from other founder friends, or even those within your category, where you say it's so common to fall in this pit, in the same
Sure.
hole?
Well, so again, saying something that's probably pretty obvious, I think there are lots of pitfalls when it comes to go to market. I mean, that's an area where a lot of businesses fail because they don't ever figure out go to market. They have a product that's compelling, but they can't figure out a way to efficiently get in front of companies or clients rather, and get people to actually spend money on it. And so my general advice around this when I'm talking to other founders is try to distill down what is your product proposition, i.e., what are you offering to a client or a customer? What is your channel approach or go-to-market approach, i.e., what are the tactics by which you are making the client aware of the offering and hopefully creating a call to action for purchase? And then third, or purchase or activity, because activity you may not monetize directly, you may monetize indirectly. And the third is, what's your revenue model? And in order for a business to work, you have to have an alignment between those three things: product proposition, channel or go-to-market tactics, and revenue model. And a mistake I see people make is they want to pick and choose, right? They want to have a partner-driven approach where they're monetizing versus, vis-a-vis advertising, just making it up. Hate to say it, that's probably not going to work unless you have a very, very specific way of making it work, just kind of conceptually. So being really crisp about that and then testing it, right? And making sure you have validation around how those pieces hold together, I think is ultimately what it takes to ultimately find product market fit.
When you were saying testing it, were there any iterations that you found yourself with Vouch going through? And I know you've already come from this industry. It sounds like you had a fairly straightforward, very clear idea of exactly where it is that you wanted to target, offer. But were there any iterations along the way?
Well, certainly there are iterations with respect to how we activated the channel. And there certainly are iterations in terms of our product marketing, i.e. how we described the product. Where we've been more consistent is what the product actually is and what our revenue model is. So those pieces have been pretty constant. The fact that we use affinity partners as a major distribution source, that has been pretty consistent. But the tactics we're using on the front end and around the partner channel, those have evolved quite a bit based on test and learn and frankly, how the market has changed.
Yep, that makes a ton of sense. Let's see what the time is. All right, well, we can, let me see if I have any other questions for you before jumping in. Let's go into, anyone have, I know, Julie, you mentioned something regarding the Series A. I was just I was looking here. I believe that Stan was describing that instead of normally, what would normally be a pre-seed or seed, they just immediately started at a Series A. So they immediately raised 25 million. And that is based on what Sam mentioned, which was your previous experience, the amazing team that you have, all those variables, partnership.
Well, and I mean, the biggest factor is we had two investors who were really excited about the idea in space and who wanted to work with us to make this a reality. And so those partners, Ribbit and Silicon Valley Bank, have just been a really important part of the story from day zero. We were very fortunate to have their involvement and their commitment to the idea in the space from the get-go. And so it's for that reason that we were able to kind of jump over those kind of early fundraise milestones, which Alejandro is exactly right on. When I say standing A, what I meant is simply we didn't do the normal way of you raise a small pre-seed, you then raise a seed, and then once you have metrics, you go and raise an A. We kind of did an A-size round as our first round because we knew that, frankly, we're going to have to invest a lot just to get the business off the ground.
Who are, Sam, that actually brings me, who are the biggest players out there that are also targeting startup founders? Who are the people that, to be frank with you, since I've come across with you, now all I see is you and your company.
Well, good. I'll tell that to my marketing team. That's great news. That means we're winning
for startups.
No.
But what are the others? Because I haven't even seen the others.
Sure. Well, so there certainly are other kind of digitally native or digitally enabled companies in the insurance value chain who serve high growth startup companies, but to a T, all of them do it as one part of what they do. To my knowledge, we are like the only, or maybe on a very short list of folks who are really dedicated to the space and have been dedicated to the space since day zero. And because of that, we've been able to, again, tailor many aspects of what we're doing so that, again, we can have a right to win. We can, do something that is truly differentiated in the end market. On the carrier or the insurance product side, there really aren't any specialists in the pure play carrier space. Many of them will do this as part of either their kind of small business effort, or they'll do it on the low end of what they do as a horizontal, right? So there are some carriers who have a technology vertical, but most of what they do within tech is really public tech. And again, the exposures, the risks, the client expectations are just different if you're a very mature company versus being an earlier growth stage company. And so we're really we've circumscribed a market that for most other people, they do it as an aspect of what they do, but not the thing they specialize in.
You mentioned that the tweaking of messaging is always what you're working on, right? Like, or what worked, keep doing that, whatever worked. So when it comes to messaging, I'm curious as a founder, what are the things that allow you to connect with a founder, right? Because when you talk about insurance, right? For a lot of people, that's not the thing that they're not thinking about, right? Like if I'm a startup founder, I think about insurance. I'm like, yeah, let me just figure out, like, I still need to work on this. We're still working on, on the product, on the go-to-market, on blah, blah, blah. And you kind of always push insurance and all that stuff in the back. Not to say that it's not important. It's just, it's not
No,
in the front.
The most important thing. No.
And so how do you go about getting the attention of a founder saying like, well, this is how most people probably think about insurance, but in your case, here are two things that you might already be experiencing that this is something that we can help out on.
Yeah, it's a great question. So let me share a stat that we learned early on as we kind of surveyed folks and worked with folks in the market. So for first-time founders, for folks who are doing their first startup as a founder or CEO, the percent of those that buy commercial insurance as part of their startup motion, it's actually pretty close to 0%. And that's just a reality for all the reasons you laid out. What's really interesting is for repeat founders, the number is actually closer to 70%.
Wow.
So majority actually buy insurance as part of their startup checklist. You come up with an idea, you incorporate, you open a bank account, you get a payroll processor, you get business insurance, you get going. And the reason for that is repeat founders know that having business insurance, I mean, I would argue is a good idea, but the other reason is you're going to need to probably have it. And so whether you do it in day 0 or in month 7, it's actually just easier to deal with up front so that it doesn't gate other things you want to do in the company. And when you raise a financing and someone joins your board, when you take on debt, when you close an enterprise partnership or sale, when you get a statutory license, if you do need physical space, if you have employees, particularly employees who are doing a lot of work in kind of the physical world, almost always insurance requirements are going to come as part of that. And so if you know that, gosh, I'm going to need this as soon as we have any momentum with this thing anyway, most repeat founders kind of make a small bet on themselves and are just like, you know what, I'd prefer to tick this box now so I don't have to worry about it when actually the important thing comes up that requires insurance.
Right. Yeah.
The other aspect of it is we very purposely designed our product so that it is low touch, fast, convenient, and pretty cheap for very early young companies, and where it's really easy to modify coverage and change and expand coverage as you grow. And so that's why, I mean, the thing on some level that we're trying to sell to people is peace of mind. We're not trying to sell you all the insurance up front. We're just trying to have it right sized to where you are, knowing that when your situation changes, or if it changes, we can be there and be very responsive so you don't have to worry about it or stress about it when the time comes.
How many startups, again, this is just pure curiosity, but how many startups fit within your target demographic?
There are about somewhere between 80 and 90,000 companies in the US that we are actively profiling and thinking about as our addressable universe.
Amazing. Very, very cool. Very cool what you're doing, Sam. Congratulations on Vouch, on your venture.
My promise would be if anyone has questions about company building, risk management, insurance, send them my way. I promise no hard sell whatsoever. I'm always just happy to be a sounding board and second set of eyes on stuff.